kind of some forced repositioning, people a little too defensive coming in, but the market's ability to perform when earnings have been a little bit messy, and we might even be, not as close to the end of the Fed tightening cycle as we thought we were about 4 days ago.
Right. So I guess our perspective on this is that if you look at the move year to date, in our view, it's mostly a multiple expansion move, essentially reversing some of the compression that we felt last year around the Fed narrative. So to put some numbers around this, as of a couple of days ago, we had mentioned that the valuation on the S&P 500 had increased by roughly 10% from the start of the year, even though bottom-up earnings expectations have fallen by 3%. So again, reflex reaction to a narrative around a less hawkish Fed that's translating into a multiple expansion around those areas of the market that were most negatively impacted last year: tech, consumer discretionary, communication services.
Certainly all that is going on in a big way. You also have a bit of a reflation of some of the more speculative parts of the market. But I wonder what you make of the fact that, look, that the move in the equity markets is pretty global. There's been some cyclical leadership. You have some things like materials and some industrials doing well. And is there a macro message in that, or is it more noise? Can we take any comfort from that and the fact that credit markets remain pretty firm as well?
I would say not yet, and quite honestly. The way we're looking at it here is that if you look at, again, the year-to-date move, heck, there are 10 stocks that account for roughly 22% of the S&P 500 that can be attributed for half of the index move. Okay, so yes, we're seeing some expansion down cap into small cap as an example so far this year. But in our view, again, the bulk of what's being construed to the S&P move is really a dynamic around a mega cap cohort that's snapping back off of last year. Now, to be fair, I do think that with some increasing confidence that we're looking at peak inflation, that certainly begins to provide a little bit more comfort that there's a backstop in place. But we're still looking at an earnings picture that is far from clear and far from setting up for a more significant follow through to the upside.
What does that imply tactically, I suppose, in terms of what parts of the market look better or worse? I mean, would that mean to stay relatively defensive and go to those areas where you have some confidence that earnings are going to come through?
Yeah, we're barbelling it, right? So we went into this year overweight industrials and energy, which were controversial at the time. And I still feel like that economic sensitive exposure makes a lot of sense versus what we're seeing on the earnings front. Real estate is a quasi-defensive sector that we also upgraded to overweight. Again, here on the perspective that the rising rate dynamic of last year is largely priced in. Healthcare is an ongoing defensive call for us that we had in place all of last year. We think it still makes a ton of sense, but it is going to lose out in a more traditional economic sensitive-led risk-on rally. But for now, we're pretty comfortable with this barbell approach between defensives and economic sensitives.